Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
Okay, so when you invest all of that hard-earned cash you got into the stock market, you're just kind of sitting on your hands, hoping for a return on your investment. Growth investing is one way to pursue substantial investment gains. But growth investing won't find a place in every investor's portfolio. Is it the right fit for you? Let's find out. Welcome to the College Investor Audio Show. First of all, what is growth investing? It's a strategy that prioritizes buying stocks that are expected to rise at a faster rate than their competition. I like that. That seems like a no-brainer. But when purchasing a growth stock, the goal is to buy stocks before the company really takes off. So, you're essentially hoping to catch a ride to big returns by investing in a company with potential early in the game. With that, investors seek out companies in strong positions to expand their business in the coming years. The investor is hoping the business expansion will provide a substantial boost to the stock price. Growth investors are not expecting to receive dividends along the way. Instead, they're hoping for big gains that will lead them to a big payday when they're ready to sell. As a growth investor, you should not look for a quick return on your investment. Let me say that again. Do not look for a quick return on your investment. Instead, growth investors are looking for the long-term increases in the stock price. With several years to grow their investment, investors in growth stocks can enjoy dramatic returns. But there are, of course, big risks to growth investment because market volatility can easily shift any particular company's fortunes. Pandemic, anyone? When seeking out growth stocks, an investor will look at measurable financial indicators such as sales or return on equity. Additionally, an investor can consider less numeric factors such as proprietary processes, patented innovations, or loyal customers. Although finding these stocks with an outsized growth rate can be easier said than done, effective growth stock investors stand to enjoy substantial gains. Growth investing is a direct contrast to value investing, which looks for companies that the stock market has undervalued. In value investing, an investor seeks companies with established financials and more modest return prospects. By the way, we have a podcast on value investing as well. Common types of growth investments. Although growth stocks can come from any industry, some categories seem to produce growth stocks regularly. A few of these sectors include, you may have guessed, technology. Innovations poised to change the tech industry are often considered growth stocks. Healthcare. Revolutionary healthcare drugs can dramatically change the future of a company. Vaccines included. Small companies in the beginning stages of their runway may have room for increases in the stock price. And speculative opportunities. Throughout the market, speculative investments with high risks can also have major growth opportunities. As you explore the market looking for growth stocks, you'll find companies from a wide range of industries. However, these are some common sectors to start your search. How to evaluate potential growth stocks for your portfolio. If you want to become a growth stock investor, man, it can be disappointing to learn that there's not a universal formula used by all growth investors. With that, you'll need to take a variety of factors into account before moving forward with any particular stock. So you'll basically be deciding on a company's potential growth with a combination of quantitative and qualitative measures. With that, it is important to realize there is some amount of subjectivity in your investment choices in growth investing. But there are still some helpful measurements to consider, including projected earnings growth. Is the company expected to increase its profitability in the near future? Strong projections could make the case for a worthwhile growth stock opportunity. Historic earning increases. Projections of future growth can be exciting, but has the company delivered on consistently increasing its earnings in the last several years? Profit margins. A company with strong profit margins could make a good growth stock. Return on equity, ROE. ROE measures the profitability of a company. An increasing ROE could be a good sign for a growth investor. Price to earnings ratio, PE. A high PE ratio could indicate that you are looking at a growth stock. In addition to these measurements, you should also consider less measurable aspects of a company. These might include the brand loyalty of the customer base, patented innovations that could change the marketplace, and of course other points of interest that set the company apart from the competition. It's very important to go deeper into the company. Now, we ask the question, should you invest in growth stocks? Although growth investing can be a good strategy for some investors, it's not for everyone. You'll need to take your own investment objectives in mind before diving into growth investing. Growth stock investors are seeking major returns, but the potential for high returns comes with an increased risk. And with that, you'll need to have a relatively high risk tolerance to comfortably invest in growth stocks. In addition to tolerating higher levels of risk, growth stock investors will do best with a long-term investment horizon. Investing for the short term could push a growth investor to sell before the company has capitalized on its full growth potential. With that, growth investing is a good option for investors that can tolerate higher risks and expect to hold on to these stocks for the long term. Beyond the debate or growth investing versus value investing, you should decide if you even want to invest in individual stocks. It can take time and energy to manage a growth stock portfolio effectively. Do you have the time to dedicate to this task? If the answer is no, you might decide to dedicate a small portion of your portfolio to growth stock opportunities while investing the bulk of your money in a low-cost index fund. Take some time to learn more about asset allocation before moving forward with growth investing. Final thoughts? Growth stocks can lead an investor to capitalize on investment returns that outperform the rest of the market. Think Apple, Google, Amazon, Microsoft. It can take time and energy to pursue these high-risk investments, though, but it could be worth the rewards in the long term. Imagine if you put $100 in Apple in the early 90s. If only. Of course, if you want to learn more about all the investment options you have, check out thecollegeinvestor.com. Thank you so much for joining us today. We hope you learned something new, and we'll talk to you again very soon.